So I thought what I'd do is just sort of tell my story, and then we can kind of do a Q&A after. But as it happens, my story sort of starts at McGill, actually. So in a maybe similar position to where a lot of you guys are at. So I did a BA at McGill in English, and then I traveled around the world, and I came back and I did an MA in English, and I was finishing that degree it was around 92, the year 92, and it was actually not a great economy. And I handed in my thesis, and me and my buddy, who was also doing a graduate degree in religious studies, which was even a less marketable degree than my English one. We were sort of, up and down Saint Laurent thinking about what we wanted to do with our lives. And we had a couple ideas. And this is actually, you guys would know this guy, his name's Evan Solomon, and he's a political broadcaster now at CTV. You'll see him interviewing the political people. Anyway, he was my buddy at the time. So as I said, we were kind of up and down the bars on Saint Laurent. So we were kind of trying to think of ideas. It was actually not a great time to get a job. So we had three ideas. One was to start a political party. One was to start an environmental organization. And the third was to start a magazine. And so the first two, we had no idea how to do. And the third one, we had a vague idea. So we started a magazine. It was called Shift Magazine. And we ran it for about more like 6 or 7 years, and it was a big adventure, and we didn't know anything about what we were doing. So we learned kind of publishing and how publishing worked. And we ultimately, we raised money from Rogers Media. And then we ultimately sold it to a Montreal-based entrepreneur called Richard Sawinski, a technology guy. And so I worked for Richard for a couple of years, back and forth from Toronto, and then a bit to New York, where his head office went. So basically, I learned how kind of business worked a bit. I learned how business worked, and just sort of in trying to learn how to run a magazine. And we had a magazine and a website and a television station, but it was pretty nascent, but it grew quickly. So when I left there, I kind of made a list. Well, what are the things I'd like to do with my next chapter of my life? And I had a real kind of sense of sustainability being an interesting, need for the world, but also business opportunity. And I read a couple things. One's a book called Ecology of Commerce by Paul Hawken that kind of got me thinking about things. And then I read a Harvard Business Review article at the time about sustainability and it kind of reframing sustainability as a business opportunity. So these things got me thinking about, what could I do in the world of business and sustainability? And I looked, one of the things I did was kind of looked at all the funds at the time that were calling themselves green funds. And they really were not, to my eye, very little that was green about them. They were kind of owning resource companies and telcos and banks and all the things that that a mutual fund would own. They typically had a view that they were kind of either screening out sectors that they didn't like, so alcohol or tobacco, or that they were taking kind of the best of class in each of those sectors. But to my mind, there was kind of a more obvious kind of sustainability angle to investing, which was to invest directly in companies that were solving problems in related to the environment and climate change and sustainability writ large. So, but I had no background in financial services. I never started a fund. I didn't really know how they worked at all. Like I didn't know the economic model. But I had this idea, and at the time, my mentor in the media space was an entrepreneur called Michael DePonsier, and Michael owned a number of magazines. So he was a kind of a family friend, and it's probably some of you know his grandson, Magnus DePonsier, but that's Magnus's grandfather was kind of my mentor in the media space. So I went to him with this idea, is there a way to invest in sustainability? And Michael was a sustainability convert already. He was the chair of the board of the World Wildlife Fund, heavily interested in all things green. And he'd also had kind of a similar idea. So I basically joined his company called Key Publishers. Key Publishers was in the was basically about to sell itself. So that Michael was kind of planning to sell that publishing venture. So I kind of joined Key Publishers. He sold Key Publishers to a publishing company, and we basically started in this new idea called InvestEco. So I was kind of, while the publishing company was selling, I was kind of trying to develop a business plan for InvestEco. So once the publishing company sold, we started this little company. We didn't have any. Michael put some assets from the sale of the publishing venture in, but we were basically starting from scratch. And so, we hired a team. One of my first people to join me is my now partner, Alex Chamberlain. And this is kind of an interesting story too, because Alex was my counselor at Camp here, Ontario, years and years before. Sorry, I was his counselor. He was my camper, and we'd been on a couple gnarly canoe trips, and but I hadn't seen him for like whatever it was, 20 years later at this point. But Alex showed up in my life, and he had a law degree and an MBA and a CFA, and he had all the kind of degrees that we needed to really run an investment company. So Alex joined the team, and we started to, basically we did our first offering memorandum. We decided where we wanted to focus. Which what we call expansion stage companies. So like early stage private companies, but and effectively a venture capital proposition, but not startups. So we were going to invest in companies with some revenues, but they were early stage and they had huge growth opportunities. So we did a first fund, small $10 million fund. In the world of the capital markets, 10 million is a very small fund, but it took us a long time to raise. It was effectively what you'd call friends and family. So it was people we knew who were willing to take a risk on a new team that hadn't done anything before, but had a kind of interesting idea that was reasonably new. So we raised that fund, we deployed it, and we invested across a bunch of sectors. So we were investing in kind of alternative power and water technologies, climate change remediation technologies, what's become clean tech, but that wasn't a term at the time, and food as well. So food was one of our sectors we identified. So we invested, I think, 7 investments in that first fund. Then we raised another small fund around 2005 or 6. Again, invested in kind of another kind of 4 or 5 companies, and then a third little fund where we did the same. And then, so like 10 years after we launched, so this is now about 10 years ago, so around 2011, we kind of looked at this group of portfolios of 3 funds and roughly 10 or 11 portfolio companies across a variety of sectors. And we decided that we would be more effective if we really focused on one sector. So if we just kind of really narrowed our investment focus down. So that's basically what we did. We looked at our previous investments, and of the, I think it was 11 or 12, but let's say 12 companies we invested in, 3 were in the food sector, and they happened to have done quite well, and they happened to really kind of marshal our skill sets well. And we kind of looked more closely at the food sector, and we decided that was the sector we wanted to narrow and focus on. So as of that time, so now 10 years ago, we decided, okay, we're from that point forward, we were really just going to focus on the food sector. So we launched another small fund called the InvestEco Sustainable Food Fund 1, and it invested in around 7 businesses in the food space, and it did extremely well. So it really took off, and then that kind of opened the gates for us to start to grow our fund sizes. So we invested in a second dedicated food fund in 2016, and that was about 3 times bigger. So it was the first, we had a $30 million fund. It was the first one we started to attract institutional investors, and we got a new kind of class of investors that could write bigger checks. And then we did a third one, and we closed that about a year and a half ago, and that was 100 million. So we're starting to kind of scale our fund sizes, starting to get this new class of institutional investors, and the whole thing flipped. So now most of our money comes from like kind of large institutions that that can write sort of 10 or $20 million checks at a time, rather than all sorts of small, investors. And it's just a much more efficient way to, for us to raise capital. It's a more traditional venture capital path. So where we are today, we've got a portfolio of about 25, mostly food companies. We tend to be, I'll say a little bit more about the companies we invest in. So they tend to be around 5 to 10 million in revenues when we invest. So they're real companies, they got real products, they got real employees, but they're scaling. So they're growing very quickly. They tend to be growing at kind of 30, 40, 50% a year. They need equity capital. So these kinds of businesses are really hard to fund through debt, through bank financing. Like banks tend not to really take risky investments. So if you don't have assets and it's really hard to raise capital. So for these kinds of companies, they really can't finance themselves effectively through debt. So our role is to come in. We would typically invest, say, $4 to $5 million in a portfolio company. We sit on the board, so we're active investors. We would usually own a material piece of the company, on average, say around 20% of the company. We would get involved, as I say, we'd sit on the board, we work with the management. We don't try to run the companies day to day, but we're there for the big strategic decisions. We're there to help the CEO navigate and find their path. And our goal is to build them up to be sort of more like $50, $100 million companies. And then at which point we would typically look to exit. And our exits tend to be either by being acquired by a larger company in the sector. Sometimes it's a public offering. So on a couple occasions, we've listed our companies on a public stock exchange, and then we can either give the shares back to our investors, or we can sell the shares and give them the capital. We did a pretty successful IPO in an egg company called Vital Farms last summer. We can also refinance them. So another option is to effectively bring on new financing at the time when we have to exit, and basically that buys us out. And so there's a variety of means, but because these funds are effectively, we have to return the capital because there's no way for the investors to get liquid. So they're kind of 10-year funds, and our goal is to make an investment, grow the business, sell our interest in that company within that 10-year horizon, and then return our capital, hopefully with a good return to our investors. Couple other things I'll say just to sort of ground the conversation, but we do look at both financial returns and impact. So impact's a broad term, but typically for us it means health and sustainability. So, and we do kind of look to the Sustainable Development Goals of the United Nations. So we would look for companies that can move the needle on at least a couple of the SDGs, and then we track those things too and report it out to our investors. So it's both a financial return and an impact return that we're trying to generate for our investors. And then just a quick thing on our company. So we're now about 10 growing to 11 people, mostly in Toronto. We have one Quebec-based venture partner who helps us find deals in Quebec, but most of us are based in Toronto, although with the pandemic, where people are kind of further afield right now because you can be, but our office is in Toronto. So I don't know, I just hit a bunch of different high points, but I'm happy to dig into any of those things and talk more about any of that.
Yeah. I definitely like kind of at the end of what you were saying there, like you kind of ticked off a lot of the boxes just on like your life story, especially because like being, especially an arts grad, like most of the people here are in arts. So it's kind of like cool to know that we have like a little bit of someone to like look up to. You don't have to be like in business or whatever to like do something like this, especially related to like sustainability and stuff, which is like what the club's kind of built on. So like I guess my opening question would be like, it's like a two-part question. You kind of already touched on it a bit. So like the first part is like, you said you use like ECG, like metrics and stuff to like have like a sustainability sort of score. And I was just wondering like, if you could like expand with more detail about like what that is, because like
Yeah.
we that's a lot of things we struggle with is finding like legitimate scores, because a lot of them are like really shady and like trying to, I
Yeah.
don't know, they don't accurately reflect if they're sustainable or not. So
Yeah, no, it's a fair point. And I think okay, well, I'll describe our process and then I can talk a bit of the kind of philosophy behind it. But it's a multifaceted process. So it starts with, we have an impact statement. So it's basically, all our investments have to adhere to a certain, and it's kind of a written statement of the things we're trying to accomplish. And one of the things what has to happen is our large investors we have a group called LPAC, Limited Partner Advisory Council. It's basically made up of our large investors. They have to sign an affidavit agreeing that each investment we make fits that. So that's one kind of gating thing. And then we basically look and we go, like, there's a judgment call component to it for us. So we're sort of saying, basically, is this nudging the food sector in the right direction? And can we get behind this investment? So it starts with like a debate in our team, and it'll go back and forth, and people will often have different views, but we'll try to, we won't really go forward unless like kind of our whole team gets on side that, yeah, this is a legitimate, this is kind of moving the food sector in the right direction. And then we incorporate like our findings into our investment report. And that goes to this, we have another advisory body called the GP advisory group. So this is also investors, but they tend to be ones who are knowledgeable about our sector. So we have people who like are like active in our sector on that group. And so we'll go and we'll talk to them about that, and they will, we'll get feedback on it basically. And at the same time, we're also trying to consider, what are we going to measure? So we have to be able to measure something. There's have to be a proxy of some kind. It might be greenhouse gas emissions reduced. It might be food waste reduced. It might be, improved caloric content, or, it's got to be something we can kind of measure. So we kind of looking and even talking to the investing company about what it is that we're going to, measure. And usually it's a couple things. And usually they're tied to an SDG in some respect. And then, as I said, we get to the next stage, and we have to, our LPAC has to kind of sign saying, yeah, and they review they review both the investment memo that has the impact metrics, the impact logic, and then the metrics we're going to be tracking, and they sign off that they agree. And then we measure it, we measure it and report it out as we go. And like, I'm the first to say, like, it's not perfect. Like I think this idea that there's like the measurability, like there's always a judgment kind of call to it basically. And ultimately, I think the most important thing is that it's meaningful to our whole team and all of our investors. So it's partly just that process of debating, the merits of it and why we're doing it and why it improves the food sector. That I think that in a way is the most material thing, and that kind of internal debate we go through for every investment.
I actually have a question. So you mentioned that you focus on food, investing in sustainable food. Are you looking to branch out into other industries outside of food? And if so, which ones do you see have the best opportunity for the future?
Yeah, so we probably won't. So we started broad, and what we discovered, like in venture capital, your effectiveness is a lot your kind of knowledge of the sector. So what we decided that we were more effective by going kind of narrow and deep, that the more we knew about the sector, and that kind of trying to play in variety of sectors just meant that you were not really an expert in any of them. So that's not to say that those sectors aren't good sectors to be in. I think a lot of them really are, but this is a little bit in respect of why venture capital is different from like a public portfolio. Like I think in a public portfolio, it's easier to be in a variety of sectors, and you've got all the information from the public markets, and it's less about, there's less kind of sectoral know-how that is core to what your returns are based on. in venture capital, it's in my view, it's much more about really knowing the sector, like being the go-to investor for companies, being able to add value to the companies, knowing how the business models work, being able to make connections and contacts. So the short answer is, I don't think we will broaden out beyond food. Slight nuance to that, though, which is that there's a fair bit in food, like even within food, like one of the things we haven't done much of is to make investments in kind of technology-based food companies, and that's something we probably will do a bit more of. So within food, I think we might broaden out a little bit. Like we've been mostly focused on kind of consumer packaged goods, like branded food companies, and I think we may broaden out within the food sector. And we're looking at, a company right now that has a fair kind of IP profile with significant patents, and so we're kind of, we may broaden out within the food sector, but I don't think we will go back to trying to be in other sectors for the reasons I mentioned.
I have something to ask. So yeah, obviously in Canada, that's a big problem with food, especially that we're a big importer of goods. So are you guys looking at any interesting hydroponic companies in Toronto?
Yeah, we look at all that stuff. So this is another, my last comment sort of holds on this, which is we've looked at a lot. We have not pulled the trigger yet on any. It's like the various kind of high-tech greenhouses, vertical farms, hydroponic, they are super interesting. But we've struggled a little bit to find one that we kind of want to invest in. Now, I have like 3 on my desk right now. So like we're continuing to look, and we're continuing to be interested in the market. And I think some of the economics are changing as the technologies get better, and cost of importing can go up, that the economics seem to be kind of at a bit of a pivot where they might get quite interesting in the next little while. But we've been hesitant to kind of yet to pull the trigger. But as I say, I could see that changing, and there's a handful that we've looked at and are continuing to look at.
Yeah, I'm asking because my best friend started a startup here in Montreal, hydroponic startup, and it was the first one in Montreal and Quebec actually. They were at 4 towers now at the R&D phase, and they just starting an expansion to 12 towers, which is a lot of goods actually.
Awesome.
Maybe you should keep this company.
Yeah, why don't you tell me the name and I'll write it down just so I have it here.
It's called Aqua Verti
Okay.
Farms.
Cool. Yeah, I mean, we definitely talk to those kinds of companies. Now, they're probably, by this description, they're probably a little early for us. So, again, we 5 to 10 million is our kind of sweet spot. We kind of look at once a company starts kind of passing $1 million threshold. But I'm guessing by the way you're describing that these guys are probably not quite at that yet. But anyway, we definitely keep our eye on that kind of stuff.
Yeah, they certainly got more than million. Like they already got huge investments by the government here.
Yeah.
And now, once they build these 12 towers, they'll start making that kind of money, I think.
Yeah. No. Okay. Well, I'll keep my eye out, and feel free to tell them about me if you want. It is the kind of company we definitely do talk to.
And I guess I have a question. Just over the last 20 years or so that InvestEco has sort of like done and seen growth, especially over like your different investments. Has your prioritization of like a specific impact assessment, like within the couple that you named out, has it like grown over time? And have you seen others get more success and actually be more effective than others when you prioritize a given one?
Yeah, it's a good question. I'm trying to think if that, I'd say, I mean, for sure, the greenhouse gas emissions in the food sector, I think, has become more of a focus over time. Like when we started in 2002, when we were, greenhouse gas emissions was an important element for like the energy investments in clean tech that we did, but maybe not yet for the food quite in the same way, but it's become so like certainly like the whole kind of plant-based protein, that plant-based meat sector is being driven in part, like it's been driven by a bunch of things, but one is an increased awareness of climate change and greenhouse gas emissions. And I'd say that's become a bigger driver of a part of the food sector than in the last sort of 3-4 years than it had been previously. And yeah, so that's the one that kind of jumps out at me. Yeah, that would be the biggest one, I think. And it's certainly like, you guys probably track some of the public companies in that space, like the one that Beyond Meat is the kind of one that changed the market, because it, heavily funded company that went public. I think it's, $10 billion market cap or something like that. So when that happens, that changes the sector. And then there was another one called Oatly that's in a related sector, the plant-based milk effectively, or dairy replacement. And again, kind of a similar thesis in part. And those are both they're both sort of driven a little bit by health considerations, a little bit by greenhouse gas emissions considerations, but I think I think the growing awareness of climate and food is probably the single biggest factor in that respect.
I'd assume the water crisis is a big thing as well, like especially with food, I know that in hydroponic farming they use like 90% yet less water to farm goods, right, which is a big thing as well.
Yeah, I think that's particular. I think that's true too, probably particularly true in certain areas where water is scarce and becoming more so. So I think that's definitely right. And transportation, but transportation is a bit a proxy for a couple things, but climate also, greenhouse gas emissions, but then like kind of freshness. And I'd say the other thing I would say is like there's a general growing interest in like just generally health and food. Like when I was growing up, we didn't think about it very much, to be honest. We just sort of ate what was given to us, and there wasn't much consideration to how our health was related to the food we ate. And now that's obviously absolutely central, and there's much more thought and consideration, and there are a whole new array of questions, like the whole kind of notion around the microbiome and the gut health and things like that just weren't on the radar screen even 10 years ago, are now very active conversations, and tons of companies are innovating in that respect. So
nice. Yeah, just before we kind of like open it up to everyone else for some more questions, I just want to ask one more question. So like you mentioned, you kind of look for companies that have like they're decently established, but they're not like super big. And I was wondering like what kind of metrics you look at when you're looking to invest in a company. Like, is it just straight sales, or like what if there's any or is it more qualitative when you're looking at a company?
Yeah. So it's quite a bit of a 360, like and I think that's true of venture capital in general. So you kind of look at a lot of things, but I would say the sales and sales growth are a big one. We would look at where the sales come from for to assess. So like the quality of the sales, basically. Like I'll give you an example, like especially in the retail food space, sometimes people would have like 80% of their sales at Costco, and Costco's a good retailer, but it's also known as one that changes brands out often. So there'd be a big risk in that of it potentially not continuing. So we would look at kind of sales, where they come from, and also you look into the sales, so things like velocities, basically. So how quickly they're turning. So we'd prefer to have a product that's turning quickly in the doors it's in, with a lot of white space to expand, rather than one that's just expanded everywhere and it's not really turning, because what'll happen in that case, so they'll be delisted and those sales will kind of go away. So we're looking for high turns, product that's demonstrated consumer interest. And then we look for we definitely look closely at gross margins. So it's one thing to have sales, but are your sales going to generate a viable economic, a company down the road? And I'd say one of the biggest proxies for that is gross margin. So, if you have good sales and the ability to expand your sales, and you've got good gross margins, you're probably going to build a profitable company over time. But if the gross margins are very low, then it doesn't matter how quickly you grow. You're just not, the boat's not going to be lifting. Now, sometimes a company the gross margins won't be where they need to be, but they have a plan to get them there, so that, as long as there's a kind of a good logical story around that. We spend a lot of time on just like the people. Like, we want people with a good vision, a good alignment. Like, we're going to work closely with them, have to really like what they're about, and their plan to grow. We look a lot at the supply chain. Like, if there's going to be a trouble, with their supply chain, then that's something we want to be confident that they can scale. We consider a question like manufacturing. Like, are they, if they're using co-packers, co-manufacturers, like outsourced manufacturers, whether there's risk to them, whether they'll, at some point, will they have to build their own manufacturing facility, and how much will that cost? A lot of companies fall on their face when they start to manufacture. Like, they grow to a certain level, but then all of a sudden, they build a plant and goes way over budget, and they don't really know how to run it. And, that can be a really critical moment because we'll kind of look a lot at that. We look a lot at there's a big consideration in our business around succession planning. So, like, it's very common in the path of our company, from when we come into when we exit, that the CEO that started the business or was there when we come in may not be the one that finishes. And there's a whole bunch of reasons for that. It boils down to, like, there's different skills for different parts of a company's growth path. So sometimes the right person to take it to 5 million or 10 million revenues isn't the right person to then take it from there to 100 million or whatever. So we usually put some thought to that. Like, is this person going to be likely the person to take it through? And if they aren't, are they going to be, are they going to kind of realize it, that when it's time to hire in, like, a CEO or will they kind of face up to that moment in a way that's to their benefit? And we've seen examples of that working really well and creating a real dynamic for growth. We've also seen examples where that's a tricky moment. So we do a pretty thorough 360. We'll call customers, we'll talk to suppliers, we'll meet the management team. We do, and then of course we do, and then valuation. So valuation in terms is the other big one. So, and this is where deals very often fall apart. So the company will think they're worth X, and we think they're worth, half X or 3/4 of X. And then there's all the terms. So we typically come in with special rights. So we usually have the right to name a board director. We have the right to have a say on future financing. We have a right to the moment when they sell the business, or alternatively to ask them to sell the business if that time comes. So there'd be like a 3 or 4 page term sheet that we go through with them and kind of negotiate the specifics on that. And that's so any one of those points can, like, so we would look at the classic, like, 200 deals to make one investment kind of thing is probably the number. And it's because every one of those steps is a moment where the deal might not happen.
Yeah. So do you have like a breakdown of, like, when you give them the money, do you make them like account for it, like with like where they're putting like your investment and stuff? Or like, I know you say you're pretty hands-on, but I was just wondering, like, how much information?
So they'll usually have right up front, we're raising this amount of money and here's how we're going to spend it. Now we don't usually like make them commit to that, because it often does change. They might think it's going to be an inventory, but whoops, something happened, and in fact they need it for this. So but what we typically do is that we'll be on the board, and usually there's a board with some kind of independence to it, and it usually would see a budget on an annual basis and have a say. So sometimes it's like we have the right to authorize the budget, for example, so that we know they're not going to go spend on something absolutely crazy. But all those are negotiated things. But we usually don't tell them, okay, you got to spend it on this, but it's rather that we're part of a process that's a reasonable process to determine how they're going to spend it in the end.
Does anyone else have any questions that they want to ask Andrew, or just from like the club in general and stuff?
I have a couple, if I can. Hi, and thank you for your little presentation. I just wanted to ask a little bit about, I guess, partially what Alistair was saying, but it seems that you entered the market pretty early, especially in Canada. And so you have this really nice, almost bird's eye view of everything that's happened in terms of how ESG focused investing in general in Canada has shifted over the years. So I basically have a couple of questions regarding that. I guess, first of all, with the EU green taxonomy, we have like new metrics of sort of assessing different stocks for their sustainability. And you were talking about how you were considering these different metrics before, but do you think that something like the EU green taxonomy can take flight in the North American context? And I was just wondering, I guess, why or why not?
Yeah. Now, here's where you guys are going to probably know more than me, because although I'm a familiar with the green taxonomy, it hasn't entered my life, and I've sort of been too busy to fully study it. So my understanding is they kind of classifying different types of funds that go, through a couple different classes, from kind of deep green to, I think it probably isn't a bad idea, actually. I think there is some room for regulation here, that the investor should kind of know that, yeah, this is a deep green fund, or this is kind of a light green fund. And, there's probably, and it is probably a regulatory body that's the right way to do that. And so, like, from the little I know of it, I think it's actually a good idea. Europe has been ahead of North America and for a long time on all this stuff. So it's not surprising to me that they're kind of taking a lead, and it will likely come across the pond to us at some point. And I think, what I'm about to say is more true of the public markets, and like in the private, like all of our investors are putting in minimum $150,000. So they take the time and they study it, and they're all accredited. They're accredited investors. So they're basically sophisticated investors. So they get to know our product really well before they invest. But for the average investor investing in the public market, I think it's really hard for them to assess, how legitimately green a product is. So there is a role, and I could imagine that the role would be more in the public side to make sure investors are aware of what they're getting into. One thing I should say, and I forgot to mention in my history of our company, but about 6 years in, we helped to launch a firm called Green Chip Financial, which is basically our kind of premise, but for the public markets. And Green Chip is still run out of our office, it started as part of our company, but we spun it off separately because it was just a different proposition, and actually just got bought by McKinsey Financial, still run out of our office, but it was a sort of an outcropping of our management company early on. Anyway, I sort of partially answered your question. I'm not sure I nailed it, partly just because as I said, I haven't really studied in super close detail the green taxonomy from the EU.
That's fine. I guess like a step back from my question then would be just in terms of, I guess, PE, just the market pricing of everything. Have you seen sort of a shift over the years? I know that it was sort of a nascency before, like in the 90s, but now people are sort of getting more interested in ESG and considering like the COP26 and everything. Do you think that there's going to be an uptick in interest and like, do you think like the PE ratio will be higher eventually for sustainable assets?
So are our valuations being driven up basically?
Yeah, exactly. And do you think they're overvalued or will be?
Yeah, that's a really good question. The one in the little space I'm in the food sector, there is definitely upward pressure, but we know it is partly why like specialization helps, because we kind of know well enough now to know where the bubbles are and just stay away from the bubbles. And we try, we have a kind of we're probably more strict in our valuation methodology, and I would say in our 10 years of being heavily focused on food, we have, on average, our deals have not gotten more expensive, but that's a bit because we're staying away from the places where they are turning into bubbles. I think that my hunch is that markets kind of correct themselves over time, so that there will be like kind of as money moves in, it does push prices up, but there's also more places for the money to go, like the universe of potential investments expands, and there's more and more businesses that are driving, say, greenhouse gas emissions or whatever portion of the ESG universe that you want to look at. So the universe is expanding as well. And my hunch is over time, those things probably come out in the wash, and just like any market like technology or whatever, there'll be a kind of a cycle, but there'll be periods where it's overvalued, and then that'll correct itself, and then investors will run away in droves, and then the valuations will come back to the right place, and they'll be undervalued, and the normal market dynamics will take over. But long term, I do think it's a good place to be. Like, I think you want to be where the growth is, right? And this is where the growth is. These are the sectors that the world needs, and I think that there's just going to be growing long-term need for these products that will satisfy the investment demand that will also be growing.
I do have one last question. I'm sorry if I'm cutting someone off. I can't see. This one is just like a funny question, so I don't mind what you think or anything like that. I just wanted to know. I was wondering, do you think that people entering the field, in terms of like your employees or other investing firms and things like that, do you think that there's sort of a shift in profiles? Like, do you think that it's attracting different kinds of people in the field? I'm from a Bachelor of Science, like global food security, and I got really interested in investing, but I'm wondering if that's sort of a trend, that it's sort of attracting many types of people.
Yeah, I think that probably is true. Like, I definitely get a fairly wide variety of people kind of talking to me about it. And I think that's a good thing. Like, there's, it's not, there's certainly like the classic kind of profile, the, MBA or consulting background, but there's also people from science backgrounds, like you're saying, and other, arts or marketing, or, and I think that's probably true, that the there's expansion of the profile of people interested. And I think that's as I say, I think that's a good thing, because I think that it requires diverse skills. I mean, certainly, like, on science is always a good way into these things. And we're, at some point will hire someone with more of a science background to complement our less sciencey background. And there's a lot of science, and tech in the food sector. So yeah, I think I certainly think that the broader ESG universe is attracting people, and the job opportunities are growing, and those are related and phenomena too. So yeah.
Thank you.
I have a question about it's like kind of related to the affordability of products deemed like eco-friendly or organic or like wild sourced or whatnot. Do you think that there's potential for, like, the products that you guys invest in there, or like, to name the few that I recognize, like Rowefarms, that kind of meat is more expensive than the meat that's like Loblaws brand or Metro brand or no name and whatnot. Or like the chickpea pasta one, like that pasta versus a normal pasta is much more expensive. And to truly like make a dent in the amount of emissions produced, or to have like health benefits for lots and lots of people, I feel like these products need to be the majority of the market, rather than just the one aisle that's kind of like health foods, which you can only go to if you have the money to afford it. Have you seen any trends where companies are trying to provide these benefits while reducing prices, so more people can eat healthy or make an impact based off their food choice at all? I don't know if that was.
Yeah, no, I get it. I get the question. I wonder, yeah, I often wonder this sort of similar things. And I also, you know, I don't love the idea that good food is only available to, you know, higher income people. Now, a couple of things on that though. So first of all, on that comment, our first food investment was in Organic Meadow, which is an organic dairy cooperative, and it was higher priced than conventional milk. But one thing I realized is it's the consumer base was much different than you expect. It wasn't just wealthier people. It was actually people were buying it almost like an investment, and so it had a much broader demographic than you would imagine. And the other thing to say about this too, especially when you get into kind of some of the, let's say some of the protein spaces, like part of it is we should be eating less. So like we've been trained to think of just like calories per dollars kind of thing. So there's a, you know, I think there's a calculation which is eating a healthy diet, but you might not eat as much, and you might be better off for not eating as much, right? You know, so generally the problem in the Western world is we have too many calories, not too few. That's not true all around the world, but that's true in the Western world. So the calculation might be a little different. A couple other comments will say that in terms of the price, they do come down as you scale. So our most successful company was an egg company in the US called Vital Farms, which is really, they really created a new category, which they called pasture raised eggs. So these are chickens that were actually outdoors in the day. For the average free run chicken doesn't actually really get outside very much, but they would make sure they were, and as a result, it's like much higher vitamins, lower cholesterol, like third the cholesterol. So also supporting family farms, so they have like 500 small family farms they buy from. But this, to your question, they started at a significant premium to conventional eggs, like probably 3-4x. But over time, as that business grew, that price came down a lot. So, you know, they were probably like $11-12 a dozen to start, and I would guess they're now probably under $5. So there is a scale effect. As these companies grow, they can pass the savings on to their customers and bring their price point down to something that more and more people can buy, and it can kind of become you know, a bigger part of a growing population's diet. I think there is, you know, there is a struggle though, because quality food is like probably always going to be a little more expensive. Like you're always going to be able to bang something out really cheaply. But the more people focus on like their health, even those that might not have as much income, they'll probably, a growing number of them, and it, particularly as the prices come down, are going to choose the healthier option for their family. So it's a bit of a moving thing, but it is something I think about, and I definitely, you know, we definitely do encourage our companies to try to bring their prices into line over time.
Okay, thank you.
I have a question. So you may have touched on this a little bit in answering other people's questions or in your own presentation, but I'm curious just to exactly what you're most excited about for the future of eco investing, seeing as though it's like a growing field in terms of popularity.
Yeah. So, I mean, I'm definitely, this is a little bit outside of our specific fund interest, but I'm definitely interested in the kind of decarbonization kind of technologies. I think that's a huge opportunity, and that everything from renewable energy, ways to take carbon out of the atmosphere, ways to use it as a building material, ways to store energy. So that, like, there's a whole kind of composite of things. We have friendly funds that we know well that are doing all those kinds of things. And I think that's a really big space. I am in the food sector. Like, I think there's I guess I'm just interested in kind of like continuing to drive out good, healthy food at a ever lower price for a greater number of people, and for and at a lower footprint. It's like, so like a continuing of what we already do. So I'm sure there will be like dramatic changes in that over time, but I'm and I should say, like, I get quite excited too about taking some of our things into other parts of the world one day. Like, we haven't done that. We're Canada and the US right now. I get kind of excited about what investing in these companies could do to developing world countries. And it strikes me that there's a really exciting proposition for funding companies in Africa and India and other Central South America, where investment into infrastructure and capital could give people a greater financial return and allow them to produce food more economically for themselves. And I get quite excited about that. I know that's down the road, because you kind of have to focus on, like, we have a ways to go before we have enough credibility to sort of extend into those kinds of things. But that personally gets me excited.
Awesome, thank you.
I've got a question, Andrew. If we still have some more time here, if you don't mind.
Yeah.
You mentioned decarbonization. So I was just wondering what your opinions are on carbon credits, and do you see a place for them kind of within the world economy here? Kind of just the notion that companies can get paid for sequestering a certain amount of carbon for their processes, or that sort of thing.
I've thought a lot about this. I and I probably got more questions than the answers. So I do think that there's an important role for carbon credits. I think, though, that right now they're falling way short, both in the regulated and the unregulated market. And part of this, I just know as a consumer, because every time I fly, I kind of look at where, like, legitimate carbon offsets to buy, and mostly they're really like low quality. Like, it's ridiculously, stupidly inexpensive. Like, it doesn't hold up. It doesn't. And there's a problem with the offset market, which is being worked on, as I understand. So what Mark Carney, our former Bank of Canada and Bank of England, is pulling together a kind of global regime for more oversight over carbon offset. So that gives me some hope. I think that carbon credits, like, in theory, it makes good sense, and if the market was working and the market was appropriate and there was proper oversight and regulation, it should make for a economically more efficient way to achieve our greenhouse gas emissions reductions. But those are all big ifs. Like, you really need oversight, you need regulation. The carbon credits really have to be additive. They have to be permanent. The important features of carbon credits have to be very much in place. And I think we got a long way to go on that. But I'm really interested in that. I think it's really important to get that right. One other thing on a related, like, I'm a huge advocate of a carbon price, and particularly like a carbon tax, because I think it kind of pushes the market signal out to all the actors in the economy, from consumers, but to all the businesses, to give them the incentive, the economic incentive to make the modifications that they need. And there's some really interesting work on this. I'm sure some of you guys study this, but things around the Porter hypothesis and the innovation, this notion of an innovation effect, that when environmental regulations imposed on economies, they very often respond really efficiently to the market signal. And sometimes they actually create economic benefits, because basically in adapting, they basically pick up on unexpected other returns. So there's sometimes the economic costs can be much lower than people imagine it would be. So, my hope is that we kind of leverage all these things like market signals and proper carbon credits, both voluntary and regulatory carbon credits, and we kind of continue to get the regulatory framework in place for all these things to kind of pull their weight. And if we do, I think we can move much more quickly than people, and much less, in a much less costly way. We can move and reduce our emissions much more quickly than people realize.
Thank you.
Perfect. I guess so. That brings us to the end of the hour. Andrew, thank you so much for coming. I personally really appreciated and learned a lot, and I feel like the same can be said about a lot of people joining us today.
Thanks for having me. I really enjoyed it. It was great to have this conversation.
Thank you. Perfect. And for all the other ESG members sticking behind, we just have some announcements in the next like 2 or 3 minutes. So if you guys don't mind just staying behind.
Okay, great to see you guys.
Thanks so much,
good
Andrew.
luck with the group, and we'll talk again, hopefully. Ciao.
Perfect.
Thanks, Andy.